I have been covering some of the best ETFs for maximizing dividend income, and the most popular ones are your active high income ETFs like covered call ETFs. These ETFs use a covered call strategy on their underlying holdings to generate premium income, which is then distributed to investors as a dividend yield. Now, the most attractive aspect of these ETFs is, for one, their extremely high dividend yields, but also the frequency of dividend distributions. This category of active ETFs tends to distribute dividends every month, and some even distribute every week. But unfortunately, it's very easy to get caught up in the hype of these high dividend yields, which leads to investors getting caught in dividend traps. And the worst part is that you may not even be aware until the market starts to exhibit volatility. Over the past few years, there has been a ton of new high income ETFs introduced, all with the goal of maximizing income. And majority tend to use a similar strategy. But there are some ETFs that try to take on an entirely new approach in order to generate the highest dividend yield possible. And sometimes this works, but other times it fails big time. And today, I want to cover an ETF that was making headlines when it was first introduced, accumulating a record amount of assets in a very short period of time because of its unique strategy. However, as you could probably tell, it did not pan out as expected. So what happened and what was the flaw in its strategy? I'll also go over a crucial dynamic that I discovered between dividend yield and NAV erosion that I think is extremely important for every investor to be aware of. And it's what I like to call the deadly trio. And yes, I made that up. If the ETF strategy involves a combination of an extremely high dividend yield, high concentration, and a strategy that limits upside growth too much, then you will have catastrophic performance over time. And this is the deadly trio. The way these ETFs work is they appreciate in value partially due to the growth of their underlying holdings and partially from the accumulation of premium income from their options activity. And then when it comes to their dividend distribution date, the amount of income they've collected is deducted from their NAV. So the price of the ETF falls back down and the fund continues the same pattern. And in a bullish market with low volatility, this type of pattern will continue. But the moment the market starts to showcase a sideways trend with heightened volatility or even a slight downward trend, because the fund still needs to distribute its dividends, the fund's NAV starts to take a hit. And that is why you'll see a price pattern that looks like this. The fund has not been able to accumulate enough before distributing the dividends. And if this pattern persists, then it will lead to NAV erosion over time. But this is a normal thing for high income ETFs. However, it is the combination of the deadly trio that will destroy your portfolio. So the first is too much dividend distributions. If the fund is not able to accumulate in value enough but is promising an insane amount of dividends, then the fund's NAV is going to depreciate extremely quickly. But the second one is the fund strategy. You see, even if the fund is distributing a reasonable amount of dividends, but then is limiting the upside growth of the underlying assets too much, that will also contribute to the fund's inability to appreciate in value, which will then lead to significant NAV erosion. That is why I put a heavy emphasis on finding covered call ETFs that give room for their underlying assets to appreciate in value by selling out of the money call options. And the third problem is high concentration. High concentration leads to more volatility. And with higher volatility, you have stronger swings to the upside and stronger swings to the downside. So even if the fund is selling out of the money call options like JEPQ and is distributing a reasonable amount of dividends, but suffers more downside pressure because of its high concentration, then the fund will still not be able to recover as quickly, and again, that will lead to significant NAV erosion. So with all that being said, this brings me to QQQY, which is the Defiance Nasdaq 100 Target 30 Income ETF. Now, the fund used to be called the Defiance Nasdaq 100 Enhanced Option 0 DTE Income ETF, but recently they have completely pivoted their strategy, and I will go through the changes in just a bit. This ETF gained a lot of popularity when it was first launched, accumulating over $300 million of assets under management in a very short amount of time. And at the beginning, it was deemed very effective because the fund's total returns were matching very popular high-income ETFs. But at the same time, it was distributing a dividend yield of around 50%, which is pretty insane. Now, if you want access to the same comparison tools, charts, ETF screeners, and ETF deep dives that I use in all of my videos, then I highly suggest to sign up with Seeking Alpha. And right now they are running their Black Friday sale with 20% off site-wide. That includes $60 off their annual premium plan, plus savings of over $220 on their premium and Alpha Picks bundle, and $480 off their Pro Quant portfolio. I highly suggest to take advantage of the sale before it ends. You can use my link in the comment section or description down below, and once again, you get 20% off site-wide on Seeking Alpha. During this run-up, we were in a bull market, and the moment the market started to exhibit more volatility is when the returns of this ETF started to lag heavily behind everyone else. And the reason is, of course, the deadly trio. This ETF not only had an unrealistically high dividend yield, but also had a strategy that concentrated itself to only income generation and was placing a significant cap on upside potential. So how did QQQY work? What lessons can we learn from it moving forward? And more importantly, why did they change their strategy? And is the new strategy effective? Well, to begin, what was unique about the ETF was the fact that the fund was selling put options on the Nasdaq 100 index as opposed to selling call options. And put options have a completely different dynamic. When you sell a call option on an ETF like the QQQ, you're placing a cap on growth potential and you don't get to experience any growth that exceeds that threshold. Instead, you're collecting premium income to compensate for it. That is why high income ETFs typically lag the QQQ. That is also why covered call strategies are extremely effective in a sideways and a downward trending market, because the extra income compensates and cushions downside volatility. But when you sell a put option on an ETF, you're not placing a cap on growth potential. This is actually a bullish position. And this position is profitable if the fund either accumulates in value or stays flat and closes above this threshold, completely opposite to a covered call strategy. If the underlying ETF falls in value, then this option position will work against you. And for those that are more familiar with options, essentially, the value of the put option will start to increase, forcing you to close the position by buying it back for more money. And I'll explain that in detail in another video. So the fund's goal was to try and collect as much premium income as possible by selling options on the Nasdaq 100 index. And the biggest twist here was that it was trying to do this every single day. Now, if the Nasdaq 100 continued on a bullish movement every single day, then the strategy would work very well. And you could see that from November of 2023 to the beginning of 2024, we saw a heavy bullish movement and QQQY was actually outperforming JEPQ, distributing a very high dividend yield while also maintaining net asset value. But the moment we started to see higher levels of volatility with downside swings, the fund's net asset value started to take a major hit. And since inception, the fund has lost over 60% of its NAV, underperforming its peers by 50%. Now, going back to the fund's strategy, when you look at its underlying holdings, you'll notice that majority of the fund's assets are allocated towards fixed income treasuries, and a small percentage is used towards selling these put options. And this was the second mistake. This strategy is too concentrated towards just generating dividend income without any exposure to capital appreciation. In my opinion, if the ETF put a portion of its assets towards investing into the underlying stocks of the Nasdaq 100, the fund would not have suffered such heavy NAV erosion, and its performance might have been able to keep up with the others. Now, digging deeper into the fund's strategy, when you look at its prospectus, the manager's goal states that they try to collect 0.25% in dividend income every single day, and that is just a ridiculous amount of income. Now, this leans more into advanced options trading, but in order to achieve such a high level of premium income, the fund manager has to sell put options that are actually in the money. And this means that the downside cap that we talked about is actually above the current trading price of the stock. So if the stock stays flat for the day or even accumulates by a little bit, but doesn't surpass this threshold, these options positions will still be a losing trade at the end of the day. Now, for those of you who want to identify dividend traps, in my opinion, the quickest way to do this is by looking at the yield on cost chart. This is a chart that shows you the relative trend in net asset value over time. And if this chart is trending heavily downwards from left to right, then it is without a doubt a dividend trap. And the goal is to try and find a yield on cost chart that is trending sideways or trending upwards. And for those of you who don't know, a yield on cost chart is a representation of the dividend yield that you're receiving now relative to when you first invested in the ETF. For example, when we look at ULTY, the fund's current dividend yield is listed at 137%. But had you invested in the fund when it was first released, then the actual dividend yield you're getting today is only 29%. And that is because the fund has suffered almost 80% in NAV erosion. It's very easy to get caught up in the hype of an extreme dividend yield, but the last thing you want is to lose your hard-earned money to a flawed strategy. So it's extremely important to have a thorough understanding of how an ETF actually works and what stocks it holds, and then interpreting that into how the fund might be affected in the long term. So what changes has the fund actually made, and what is the new strategy? Now, just so you know, the new strategy hasn't been implemented just yet. First, QQQY has cut its dividend yield by nearly 50%. A few months ago, the yield was around 90%, and now it's down to roughly 44%. And this shift is clearly an attempt to preserve NAV. Like I've explained before, this is one of the deadly trio issues, and the fund is now trying to correct it. As for the new approach, the fund is projecting a shift toward daily expiring call spreads, essentially a daily covered call style strategy. And that is all for this one. If you haven't yet, make sure you subscribe to my channel and hit that thumbs up button for the YouTube algorithm. Thank you guys so much for watching, and I will see you in my next one. Bye! This video is for educational and entertainment purposes only and is not financial, investment, tax, or legal advice. Discussions of ETFs, investing strategies, market updates, or specific funds are general, not tailored to your financial situation, and should not be relied upon for decision making. Investing involves significant risks, including total loss of principal, and past performance does not guarantee future results. I am not a registered financial advisor. My content reflects personal research and publicly available information. I may earn affiliate commissions from mentioned products or links disclosed per FTC guidelines, but these do not influence my opinions. Always consult a licensed financial professional and verify information independently. By watching this, you agree I am not liable for any losses or consequences from your actions. International viewers should consult local regulations.